Good afternoon, everybody, or good morning or good night for anyone watching. My name is Angel Vasquez. This is another episode of Between Bears and Bulls. As I said, my name is Angel Vasquez. I am here joined by our guest, our expert in finances, our expert in economics, Yinka Majekodunmi.
Thank you. Pleasure to join you today.
Pleasure to have you. Yinka, today we're going to be discussing the matters of compound interest. We're going to be discussing how to build wealth over the long term. This is, I believe, a very good topic for people of a young age because we're so used to, hey, you have a job, you get paid, a salary and go waste it however you want. But we never really learn or talk about preparing ourselves for matters of retirement, right? Or just even having that little bit of money maybe as a little emergency fund if we ever need it. So I'd like to start off first and foremost with what are compound interests?
Well, that's a very good point to start with. Is the main benefit of retirement investment is the ability to take advantage of compound interest, which is different from simple interest, right? And typically, in the industry, it's called just getting interest on top of your interest, which which kind of works the same way for debt. But, the effects of compounding is outstanding and astounding too, because when you put money aside and you get a certain amount of return, and that becomes your new baseline for the next layer of interest, the growth rate is increased as opposed to getting simple interest. And, to make this very simple, you see this in bonds, right? If you have a bond that's giving you interest, it's simple interest, you get every period, it's very simple, nothing special about it. But if you have an instrument that gives interest on top of the interest you earned, you're multiplying your return. You're increasing your return by a certain multiple. And so this is why compounding is very important, especially when we talk about retirement benefits or retirement investing, whichever path you use. The idea is to continue to get interest on your interest to increase your returns. That's essentially what it is. And the results are incredible. That's why, they say if you invest just X amount of dollars per month over a certain amount of period, you have $1 million. And you start thinking you start doing the math wait, I think I only put in 100,000. How do I have $1 million? That's the effects of compounding interest and compounding, basically. That's the effects of compounding.
And it's good that you mentioned that because, and I like how you mentioned, one of the forms is bonds, because a very big question, or maybe not such a big question, but something I'd like to clarify for our audience out there watching this is different ways of compound interest, different methods, because you have, we all hear 401ks, okay, but that just can't be it. That can't be the only option there. It has, here in the United States where there is a massive variety of everything, there has to be more varieties. I've heard we have Roth IRAs versus traditional IRAs. I've heard we've had, I believe you and I once discussed 403As, something like that. You have CDs, bonds, so forth. So we could discuss those.
Yeah, so all of those things have the benefit of compounding, right? Because something as a 401k, we talked about 401k earlier, but that's an easy one to start, right? 401k is a retirement account that's typically set up by an employer. Right? You get 401k through an employer, as opposed to an IRA, which you set up on your own, right? So that's the major difference. They're both designed to do similar things. Save for your retirement, that's what they're supposed to be doing. The path is just very different. The major difference between both, essentially, one of the main differences, apart from employer-driven versus you doing it yourself, is the limits. The IRS is definitely a little bit more generous on the 401k limits, contribution limits, as opposed to the IRA contribution limits. And then when you get into the types of IRA, Roth, traditional, and the limits also vary. So that's a more complex navigation because there's tax strategies involved in that. But just from a basic standpoint, whether you have an IRA or you have a 401k, your objective is to invest for retirement, but also to benefit from compounding, right? That's the objective, because the more money as you put money into it, the growth rate is added back to your account. And the next interest or the next growth that you get will also increase your total balance. So it's like the gift that keeps on giving in a way where your outlook is more long term, right? Because this is not, you're not doing 401k and IRAs to withdraw the money in a year. Obviously, we talk about penalties, but the goal is long term planning for retirement. That's essentially what they are. One your employer gives you, the other one you could set up on your own, you set up through a small company. And the key is both scenarios benefit from compounding. Your goal is to make sure money goes in there in whatever capacity you can. 401k also, you want to talk about the matching, right? So you have the matching for the employer. I always tell everyone this, and we always wish we knew this earlier. If you work for a company and they say, we have 401k plan, and we'll match you dollar for dollar. Whatever you put in, we'll match it. It is insane not to sign up for it. It's insane because it's literally free money. I mean, that's as free as you're going to get, right? Because if you put $10,000, they put $10,000 in it for you too over the year, and you get in a $20,000 retirement account that's benefiting from the growth, benefiting from the interest and the compounding of both. And maybe you have, the period of time where you have to work for the company, before you have access to ownership of the balance. But it's just a no-brainer, right? Is step one, 401k. Company does 401k, you should prioritize it. Maybe if you don't have enough flexibility in your budget, you could manage around that, but you should definitely prioritize getting that free matching from your company. On the other side, IRA depends on if you want to put additional money up for retirement, if you want to diversify, there's different ways around that. And the concept is just about managing your retirement and managing in a way where you could benefit from time. That's what compounding really is. You benefit from time because the interest is also getting interest. That's the best way to put it, the simple way. I don't know if that's more complicated, but
it's a good way to put it. It's a good way. And I'd like to discuss too bonds, because I'm aware that bonds, depending on the way they're structured and the way they're set up, right? You have a maturity date, and by that maturity date, you also have a payment plan, be it semi-annually, be it annually, and it has a certain rate, a fixed rate most of the times.
Yes.
But I'm aware with bonds, although they're considered more stable manners, there's also the possibility of maybe it can lose you a little bit of money.
Yes. Well, so bonds are very safe, right? When we say bond could lose money, it is not in the same sense as stocks. When you lose money through bonds, it's probably because the company went under, right? This is where bond ratings come in play, right? Because you could tell the riskiness of the bond you're investing in. It shouldn't come as a surprise. Sometimes it's a surprise, but most of the time it shouldn't be, because reputable agencies have rated this bond. So if you're buying a bond that's a C level or low junk bond, the interest rate will be higher, but your risk of losing
is higher.
If you want stable payment streams, you get a very high rated bond. They pay you. You're having a risk. You don't have to worry about them going out of business. So again, high risk, high returns, right? So with bonds, is more predictable when it comes to risk, because an agency is rating them, so that way people in the market know, right? They know, and obviously there's been different situations where bonds have been packaged in a very interesting way to mask the riskiness, but we'll save that for another day. But essentially, bonds are also supposed to get you interest. Most of them are, a lot of bonds that I've seen, obviously they have simple interest bonds where they just pay you the interest rate on a periodic basis. It's a way of investing. It's a low-risk investment. It's really supposed to protect you from inflation and any other adverse economic effects. But your goal is the same. Gain interest from the money you have. Now, can you reinvest the interest? Of course, you could do different things. But the bonds are one of the safest because, A, they're debt, right? And B, they have a rating system. So if you're buying a junk bond, you should probably not be. You should probably not pop any champagne bottle. Just wait until the end of the term before you pop a champagne bottle because it's high risk. So you choose and you decide what risk you want to take on bonds. But one thing you know on bonds is you're getting paid your interest at the periodic timetable of your agreement.
Okay, and that's good to mention. Also, in terms of a corporate perspective of bonds being related to companies, and on the matter of companies, right? Because a good amount of companies tend to issue stock, right? They're publicly traded companies, and one way I've oftentimes heard of building your personal wealth over a long time is investing into stocks that pay dividends, and then whatever dividend they pay, you reinvest it back into buying more stocks that pay dividends. And I've heard this term called a snowball effect, where you have the small snowball, but over time it just evolves into this massive figurative snowball that really is just a large amount of money that comes into you.
That's a good example of snowball, but that's also a good example of interest on compounding, right? Because there's a lot of, I'll say tools, I won't mention the name of the tools, but the investment tools, where if you have a dividend paying stock, right, you could opt to take the dividend and reinvest it into buying more shares, right? So think of the cycle, right? You have a benefit of the compounding effect if that company's stock continues to perform well, and you keep adding back into your portfolio, right? You add back to your portfolio. That's the benefit of that. Now, on the flip side of it, right, there's still the risk factor that you have to assess, right? Because when anything related to stock is still based on the health of the company and the performance of the company. Because if the company goes under, you not only lose your portfolio, but you also lose your potential of future dividend payments. So, it's high risk. Not high risk, but it's a decent amount of risk there. But you have to be aware of the risk based on the company because that's company specific also, right? It's transparent. You know what company you're dealing with, unless it's packaged a different way, but you actually know what you're going to get because the dividend rate is normally announced ahead of time, right? So you know whether you should sell, and then if you sell, there's a period of time where you can still receive dividends, or there's an agreement that keeps your dividend in play for that period. Now, from a buyer's perspective, dividend-paying stocks are really designed to create passive income. Right? Because you're not really buying and selling stocks. You've bought the stocks of this company that's a dividend paying. You know every certain period you're going to get either a check or a transfer, and you decide what you want to do with it. So it's a passive way of investing just to get dividends as a source of income for you when you have additional capital to put through the the investment world. Whether or not you want to go common, whether you want to go preferred with dividends, whether you want to know bonds. Those are the decisions you make when you're dealing with the corporate world, right? How you want to invest in corporate world, especially in the equity sense. Then the debt side, I think last time we spoke about the seniority in the event of a negative dissolution of the company. But think of it like this: the bondholders are still going to be at the top, right?
The pecking order.
The pecking order. The preferred are next, the dividends, and then the common stock is still the last because it's high risk. That's why we call it high risk. Right? So you always have to think of the pecking order to determine your own risk, right? What's the risk tolerance, right? What is your take on the level of risk you want to have? And sometimes people are okay with getting just a small dividend per month or per periodic basis, and they know that at the end I'm not exposed, right? Because I'm okay with that. Now, can I buy common and just hope or wait for the company to increase in value and the shares to increase in price? Yes, you can, but you have to decide that risk yourself, right?
it's good to mention that too, because now, so getting into stocks is a fairly, I don't want to say simple, but it is somewhat of a straightforward thing that you can, the average person can kind of figure it out.
Yes.
Right. Getting into stocks when it's more per se advanced or intermediate options, or buying bonds in the company, that's a little more exactly complex.
Yes.
But when it comes to these things like getting into a Roth IRA or a traditional IRA, the 401k you explained, that's set up by a company, which subject to whatever company you work for, maybe they match you dollar for dollar, or maybe they match you, 50 cents or 60 cents on the dollar.
Right.
But there's also matters of CDs, REITs, I believe they're called, REITs, right? And you have all these other matters. How would you get into bonds? Treasury bills is one I didn't mention before.
Right.
A Roth IRAs, etc.
All those are available on platforms. And I think we're going to say this every session, right? Know who you are. Mm-hmm. Two things that you touched on, CDs and REITs, right? Mm-hmm. CDs, very, very low risk, because you're giving the bank a certificate of deposit, right? Mm-hmm. It's so simple. You give the bank a certain amount of dollars. Mm-hmm. They guarantee a certain interest payment for you over a period of time. When the date comes, you get your original and the interest, and you're good. It's very low risk. Like, that's why CDs, certificate of deposit, it's a low risk. But the interest rate, it's not, your upside is not as great as a stock, right? Nobody's going to give you a CD with 20% or whatever percent. I think I've heard in a few years ago there was high CDs, but CDs right now, the percentage rate, the interest rate is very low. It's nothing. It's just supposed to, I call that something that protects you from inflation, essentially. I wouldn't go as far as saying CDs are going to make you enormously wealthy. I think it would protect, your asset, your cash asset a little bit better than savings account, because the interest rate on a CD is higher than savings account. Why is that? Because the CD has a lot of restrictive covenants in it that you can't withdraw the money until a certain period of time. And if you do, there's penalties for that. Savings account, sometimes, you put money in your savings and then you take money out, you see something that you want to buy, you take it out, and then next month you take it out. There's a maximum number of withdrawals you can make in a lot of savings account, but it's still savings. You could go in and out of your savings account and withdraw. But CDs, there's penalties if you try to take your CD, or cancel your CD or take money out of your CD. So those key differences gives you an idea of, yes, I'm stable, but my percentage of interest is low, right? Here, I'm stable, I have a high interest, right? But my liquidity is now low because I can't just go in and take the money, which is exactly what REITs are trying to solve. Excuse me. So, real estate investment trust. What is the problem that real estate investment trust is trying to solve for the investor? What are they investing in? They're investing in real estate, right? If you had to buy real estate, you had the cash, right? $200,000, you bought a $200,000 real estate property, and next month you needed money. Can you easily sell your real estate to buy something on Monday? No.
It's a liquidity issue.
Liquidity issue. So REITs are trying to solve for that, because they're giving you the ability to invest in real estate through an exchange. So you're buying it like shares. Okay. Right? But guess what? If the underlying asset, which is the real estate, appreciates, or maybe is income driven, where the rent proceeds are being distributed back to the investors, then you get the benefit. But guess what? If you ever have a liquidity issue, you can sell your REITs, which you can't quickly sell because they're on the exchange. Remember, things on the exchange are easy to sell. You go on the app, you sell, you're done. But if you have a house, I don't think from Monday at 5 o'clock to Monday at 6 p.m., you could sell a house to get some liquidity, unless you go get a line of credit, and that's a completely different conversation, and good luck on that interest rate. So it has its ability to solve liquidity issues, and that's one of the biggest advantages of REITs, is trying to give you the benefit of investing in an asset class without too much of the risk exposure when it comes to liquidity. You could still sell it very easily on an exchange. So REITs solve that problem for you. They also have the risk like any other real estate transaction, right? If the market goes down, if the renters don't pay, and also they have management fees. So you have all this additional costs that you have to weigh. But if the management fee is worth it for you to have the liquidity, then it's a good deal, right? But it's an option. So you could decide CDs, REITs, savings account, which is probably the worst return right now, right? Forget checking account. We're not even going to talk about checking account when it comes to interest rate benefit, because it doesn't even give that much.
That was in my next question right there, savings to checkings.
Yeah, so savings is better than checking, but we all know checking accounts. If you have a checking account that's giving you a high interest rate, I'll be very concerned about the bank that you're working with. So checking account is not designed for that. Checking account is just supposed to give you a mechanism to pay and receive money. It's not designed to give you any type of interest benefit. That's why you go into a savings, because why? The banks need to know that this money is not needed immediately, right? But in the sense of a checking, by definition, they know you're using it to receive money and pay bills, so they can't really completely rely on your balance, right? Savings account, they at least know, okay, this money's going to be here for a little while. We could loan some of it out to somebody. We could invest it, and the CDs, we know this is locked in for a year. He put a year CD. This is locked in. We could invest the money. We could loan it out. The banks will make decisions. Banks have to make money too. So all these categories, the interest rate gives you the vision of exactly what type of risk you're taking. That's just how it is, right? So you have to be aware, and you have to know that interest rate is indicative of the risk you're taking and your liquidity capacity in those investment tools. So overall, they have their scale, make a decision, but at the end of the day, you as an investor, you want to benefit from compounding. You want to get returns on your interest because you're reinvesting it back. You want to make sure that your portfolio accounts for your liquidity risk, right? Because, depending on the stage you're in life, I think Professor Thompson talked about how his liquidity needs changed when he became a parent, right? You can't have, all your money tied into assets. So all those decisions play into which one you select at the end of the day. And then when you go really long term, then you're talking about retirement tools, and those are highly restrictive. There's a lot of laws. There's huge penalties if you try to withdraw from your investment account, from your retirement investment account. And for good reason, because a lot of them have tax benefits. So you go up the scale, check-in, savings, CD, REITs, and then you go IRA, and then the longer you go into the line, the more restrictive you'll see. You see tax benefits, and then you see a lot of restrictive capacities around those tax benefits. And then if you use it, obviously there's also not just penalties, but there's also tax ramifications, right? So let's be clear. We're not just talking about penalties. We're talking about also tax ramifications when you use your retirement account before your retirement age. So there's ways to go about this. There's things to think about. But when it comes to retirement, I think you need to be cautious about penalties and the tax ramifications.
And it's good that you mentioned that, because a lot of people, and I guess this is just human nature in a way, right? We learn about something. If it catches our intrigue, we jump straight into it. A lot of people don't look at the what are they exposing themselves to as well. Because, I might buy an option in X company, and it might make me a lot of money, but I'm also exposing myself to losing whatever money I just put in there. And of course, as you mentioned, bonds, CDs, those tend to be a little more, not a little, much more secure. But I am curious, because we know bonds in terms of stock, right? And we know bonds in terms of maybe the government issued this bond, or you bought this bond from the government. Right. But what about bonds when it comes to Forex? Because Forex is we mentioned this in an episode. It is geopolitically affected, right? I believe this week we just saw there was a meeting between the Federal Reserve and Jerome Powell was talking about interest rates, and that matter sent the stock market roaring high. But I can only imagine what it did to the forex markets.
Yeah.
Not only here in the States, but
international.
Globally.
International.
So how does that work in bonds for forex?
It is so. Economics activity is complicated because so many things are interrelated, right? Why would a Federal Reserve announcement related to interest rate affect the stock market and then affect the bond market and then affect forex? It was like, but what? We take it for granted, but like, why? Because the interest rate affects the banks. The banks directly affect the health of the economic system. If the banks are able to loan more money out, people are able to do more things. Business is supposed to grow with the loan. If you get more interest rate from your deposit at the bank, you're going to invest in other things. You could buy more things, and if you could buy more things in a long stretch of imagination, it improves our imports, right? We're buying more things, we manufacturing more things, and creating more production, essentially. When you create enough production and you have a healthy economy, your currency is healthy, right? Because people need your currency. And we have a different situation in the U.S., obviously, because a lot of countries need the U.S. dollar to settle certain types of transactions, especially when it becomes a conversation about crude oil. They literally need dollar reserves to transact in oil, right? Now think of it. If interest rates continue to rise, which is pulling money out of the economic system, what happens to the dollar, right? There's a direct impact because people will not have money to spend, right? It affects people, and then it impacts how we produce, impacts how we buy. Now, you could follow that trail, and you could see how a decision by the Federal Reserve trickles down through the banks, trickle down through the tools that you have, ends up being a import-export issue, and ends up being a forex issue. Part of the things that we don't even talk about, tourism impacts forex. Because a lot of people who exchange money are people who are traveling to a country, right? And so if they travel to your country and they need the currency, there's going to be demand for it. Like if, put it like this, if you had a forex booth at the airport, which currencies are you going to be selling there?
American dollars, and then probably euros second.
Exactly. Why? Because the demand is there. People are going to come in. They need the dollars. They need the euros. So all those things trickle down, and that's the magic of the financial cycle, as it ties from the Federal Reserve to the banks to the economic system, and then you see forex. But forex as a operation, which is, and I'm kind of hesitant to call it an investment vehicle. I'm very hesitant. It's a mechanism to hedge. Really, that's what it was designed for. Because if you're a business, right, that you literally sell products to China, maybe that's a not well-timed example, but let's use that for a minute. There has to be an exchange, right? Or on the opposite side, if you're a business that you opened a new office in Taiwan or Spain, most of your customers are going to be paying with local currency, but your headquarters here, and so you need a medium of exchange. Now, can you hedge by saying, I'm going to buy X amount of euros at this price through the forex? If you are a forex trader, he's like, yeah, of course, I'll sell it to you for whatever, $1.10. But what if the dollar appreciates in that period? You've already sold. You've sold it already, right? So these economic activity is not so simple to just troubleshoot, right, to the root cause. But you do know that Federal Reserve interest rate impacts our economic activity. Economic activity impacts consumer behavior, impacts government spending, impacts outside investing. And at the end of the day, the way to look at it is, if business transactions have to operate internationally in a global economy, you will have a Forex industry. The health of the Forex industry is completely up to the features and levers of the international trade. That simple. I know it sounded a little bit complicated, but it's that simple, and not so simple. But if you understand that, I think you could see why Forex is attractive for people, because they use it as a good exchange to make a markup on the transaction. But you could also see why it's so risky.
It's good too, because and I like how you pointed out from the corporate perspective. Because one of the things I remember when I was starting here at Atlantis University about, I'd like to say 2 years ago now, 2.5 years ago, one of the classes I actually had with Professor Thompson, one of the topics we covered there was MNCs, multinational corporations. And if I remember correctly, one of the lessons there was if or if company A is operating in the U.S., but they opened up they opened up a branch location in the U.K., and then they opened up another branch location in the European Union.
Right.
Now you're talking with 3 different currencies.
Right.
Now they have the U.S. dollar, but now they also have the euro, and they have the pound sterling, which are, those 2 alone already have, in theory, or as it's shown right now, they have a higher value than the American dollar.
Exactly.
And the other thing that I like about it too is because considering those matters in a corporate perspective, especially from a financial accounting perspective.
Right.
When you're transferring the profits from the UK or from the EU over here, right? Last year, for example, we saw, so inflation here in the United States was, 9.1%, something around there.
Right.
In places of the EU, it reached double digits. In the UK, I believe it had reached something around 11%, something in the double-digit range.
Right.
And transferring that extra income here, well, not only was it a hassle, but it's something that they really, like, corporates have to be very on top of, because if they misrepresent their income, now you have issues with the IRS, with Uncle Sam. Now 100%. You have, you're going to have a bunch of people knocking on your door saying, 100%. Hey, listen, why did you have this issue? And now it's just a massive headache to deal with.
Can you imagine being a company that's involved, like there's a food company, a fast food company that has a location in almost every country?
Yes.
What does their currency transaction look like on their financial statements? And what happens when they have to mark this thing to market? It could be complicated. So, and that's just on the corporate front. When I'm talking about the individual front, like we're talking about tourism and all that minor impact, transaction. But on that front alone, think of the level, if you're the CFO, the level of activity you have to do in the Forex market. You may not want to call it the Forex market, but essentially that's what you're doing. You have to make sure you're assuring your company of receiving your money in your country's currency at a certain rate. That's your responsibility as the CFO. And typically you want a favorable rate. But also the Forex trader or the bank also wants a favorable rate, right? They're not going to sell it to you at a discount. So times thousands of companies. That's the industry you're looking at.
No, and one thing I found interesting, and we'll set this for another episode, because Forex alone is such a massive topic. I remember seeing a chart once where I believe it was you could leverage stocks maybe like 1 to 10 or something like that, but then the Forex was insane. It was like incredible. 1 to 32 or something like that. Massive upside, but massive downside.
International.
And one of the things that I guess this is more another example of the longevity of wealth, right? Building wealth in terms of for the future.
Right.
For Forex traders, one of the most, I guess we could say, infamous, however, was George Soros, right? Where he didn't so much. The story behind him was that it wasn't exactly he had bonds or stuff, but he shorted the pound sterling to, it caused a headache for the the English bank.
Yes.
I remember I think he made about over $1 billion in a single day of trading, of just shorting and shorting and shorting.
Good point.
And like I said, we'll leave this for another topic.
Right,
because
but I'll leave this question out there for when we talk about it. What did he know about the economic activity to be able to place that bet?
I remember reading that, but we'll leave that. We'll definitely leave that.
That's a key question, right? When you place in a forex bet like that, what do you know about the economic activity?
Oh, yeah.
To be able to make that kind of bet, a huge bet. That's for another day.
Yes. So we discussed briefly savings interest accounts to checking. So checkings, you mentioned, they're not designed for the purpose of, hey, I'm the bank, I'm going to pay you, this interest on whatever money you have. Their checkings are more like banks already know. Listen,
transactional.
You put this money here, you put $1,000 here, but truth is that 1,000 doesn't stay there.
Exactly.
The next day you might already take out 120, or you might take out the whole thing, so forth. But then interest accounts, banks are not interest accounts.
Interest-bearing accounts like savings or CDs.
But savings account, on the other hand, banks, they have them set up more with the purpose of, you have this money there. In theory, it's set there because maybe you're creating like what a lot of people usually, a lot of experts have usually said, have a little cash emergency fund.
Have a goal.
Exactly. Or maybe, for people my age, typically you save because you want to buy yourself something. You wanted to buy yourself your first car. There are people who want to get into real estate. They're saving up their money to put that 5-10% down deposit on their first piece of real estate.
Exactly.
So all this to really ask, you mentioned, CDs are better, but they don't pay a massive, interest rates.
Right. CDs are better. CDs give you more interest, a high interest rate than savings account. And the reason for that is, A, they have a lot of restrictions.
Yes.
You can't go and change your mind, right? There's penalties for that. Savings account has high interest rate than checking for obvious reasons. But savings accounts also have restrictions. My bank doesn't allow me to do more than 6 withdrawal per month. When I get to number 6, they warn me. Like, you can't do any more, or they'll charge you this, or they'll take away the interest rate. There's penalties because banks are businesses. I think we forget that.
Yeah.
We think banks are just a house to store money. Banks are businesses, so whatever money you deposited, they also have to reinvest, either through loaning people money or investing in other things. And at the end of the day, they have to make the money. If they can't assure that your money is going to be there for them to invest, then they can make their own decisions corporate-wise. So I think the simple way of looking at this is from the bank's perspective. The higher assurance they have in your cash being in your account, the more flexibility they have on their own investment strategy, and the higher interest rate they could pay you for keeping your money there for that period. It's just that simple. If you're going to keep it for a shorter period, they can't do much with it. So they're not going to give you any interest on that money, i.e. a checking account, because they know the frequency of withdrawal is high. Savings account is like, okay, at least he has maybe 3 months to 6 months to a year. Maybe he has a goal. Maybe he wants to buy a house. Maybe he wants to buy a car. So we could safely say this money will be here for a longer period than his check-in, and we put a restriction that he can't have more than 6 withdrawals per month. That helps the bank. And
it's good because one thing I'd like to mention too is for savings accounts, right? Banks are looking that you have that money in there because, as you said, they're businesses also. They're looking to how they can also, because they have to hold this money, but they also need to make their own money.
Of course.
Banks, I've heard, I've never seen this actually happen. You open up a savings account and you set up a goal, but and you give it a certain period of time, right? 3 months, 6 months, whatever. But you don't reach that goal, you don't save that money. I've heard that banks are capable, and sometimes they actually will just close down that savings account.
Well, banks have the ability to close down any account and give you your money back. And in some cases, if there's some issue or legal issue, that's a different story. But not just for savings, bank could close your checking account. Like if you're using it improperly or there's some, illegitimate transactions happening. So bank typically will close your account. Now, for the savings account, they do not have to close it if you get to your savings goal. Typically, that's not what they want to do, right? Because if they close it, then they have to give you the money, right? So obviously, it'd be in the best interest of the bank to, okay, congratulations, you met your goal. The money could be here for whenever you need it. If you want to take it out tomorrow, fine. If you want to keep saving and increasing your nest egg for your next goal, sure, use the account. So, banks have a lot of flexibility on how they interact with customer accounts, and they could close accounts. However, they shouldn't open accounts without permission. They could close account without your permission, but they shouldn't open accounts without your permission.
Yes.
A certain bank did that, and they got in trouble.
They had. I'm not going to mention the names.
Right.
Yes.
We don't need to mention the names, but that's the idea, right? They could close accounts.
And on this topic of savings accounts, because there was this, I guess, I don't know if it existed before, but as we all know, during the pandemic, right, the basic rule of economics, supply and demand. There was high demand, there was very restricted supply.
Yes.
And that led to interest rates being, shot through the roof, right? In some countries more than others.
Right.
But I also saw that in some banks, they started offering a matter of accounts, but that they pay you a high interest rate. Some I've seen that pay, 4%, 5%. I believe I saw one that went up to about 7 or 8%.
Right.
And to me, I look at it as I'm not an investor. I don't know this professionally, but I would imagine, okay, if inflation is maybe 3% right now, I believe we had the report come out at 3.2 recently.
Right.
But there's an account that's willing to pay me, 4%, or it's willing to pay me, 5%, 5.2. If I'm getting that extra 2% and I have that account full of, I don't know, say $10,000, that 2% that I'm getting is, an extra $200 just income. Yeah. How would you, or what would you advise to people? Because I imagine these accounts aren't going to be around forever. These are...
No, they won't be. And most of them, the bank has the discretion to adjust the interest rate anyway, right? So good things don't last forever. And there's a reason when a bank is given such a high interest rate, it's because the economic conditions require that. If there's high inflation, meaning the prices of goods and services are relatively higher than they used to be, and interest rates are high, like interest rates are right now a little bit. If you want to buy a house and get a loan, interest are kind of high. The bank has to incentivize you, right? And the only way to incentivize you is by giving you a higher return on your money too. So they have to give you a higher return to account for the increased inflation in your economic area, or whatever country. I want to say country, but economic area. It could be a country, it could be local, it could be multi-country. But the goal is that the banks are trying to compensate you, because the banks are also loaning money out on that high interest rates. The grocery stores who have a line of credit are also paying a high interest rate. So they will incentivize you by giving you a high interest rate on your money, because if you put your money in a bank and the bank is paying you a 3%, let's just say 3% interest on your money, but inflation is at 10%, you're literally losing money while your money sits in an account. You're eroding your purchasing power. So interest rate that banks offer. It's not because banks are nice and they're generous. They're either using it as an incentive to attract customers, or is indicative of the economic conditions that exist. There was a point in time during the time of the pandemic, before the stimulus package started coming out and all the loans and PP and all the those funds that came in later. Before that, interest rates on buying a home was 3%. I don't know if anybody remembers this.
Yes, I remember.
Right? Because everybody was still in full panic mode. Everybody was like, I don't know what's going to happen. I need to hold on to my cash. People were really holding on to their cash. And because of that, interest rate started dropping, because they want to incentivize you to spend your money. So, hey, if you want to buy a house, interest rate is 3%, you can buy a house. There was a benefit to the society and the country to do that. Like, we need to incentivize people to spend money. And so the low interest rate obviously helps you spend money. It incentivizes you to spend money because you feel as though you're getting a better bang for your buck. And those interest rate points are incredible. I think we had a conversation about, if you bought a house for $400,000 at 3% and you bought the same house at 7%, the payment, think about this, talk about compounding. The payment is almost 60% higher just on 3 percentage points. This is the reality of interest rates. This is the reality of compounding. And so every time we talk about funds and interest rates, I think we should make the correlation between economic activity. We should talk about compounding because the number one criteria, mental criteria, when it comes to investing is understanding interest rates, right? Because you invest in to get a higher return, right? That's your whole purpose of investing, right? Otherwise, you just keep the money under your mattress, right? Trying to get a higher return. And depending on the tool, and all the tools that we use, the tools that we use in all of them, all they're really doing is giving you a certain return for the risk you're taking. That's it. But our objective is the same, whether you do Forex, whether I do Bitcoin, whether somebody else does stocks. Our goal is to get a return on our investment, period. And that's measured in percentages. Person with the highest percentage obviously wins the game. So there you have it.
That's an amazing way to put it. And, now kind of moving on because we spent a good chunk of time just going through, Roth IRAs to traditional IRAs, 401ks, CDs.
It's a lot.
REITs, right? We just went through Forex and their bonds and how it is geopolitically affected by what happens around the whole world. Now I kind of want to discuss, we slightly, commented on it, you commented on it a little bit, but taxes on compound interest. And I want to take this on two different terms, okay? Well, I'm going to divide it into two questions, okay? Because I know you can have a positive compound interest, but then I know you can also have something like a negative compound interest.
Yeah. I'll call it something different. I wouldn't call it compound interest if it was a loss.
Cool, compound loss.
Right.
The taxes on this matter, because you mentioned, right, so Roth IRAs and traditional IRAs, although they're structured somewhat differently, they still get taxed. Right. CDs get taxed and they're heavily regulated.
Exactly.
The money you put, well, maybe not on a savings or a checkings account because it doesn't give you that much, but they still get taxed regardless.
Right, it's reported.
And, I'd also kind of like to discuss how these taxes are transferred because I've always heard that, look, the interest rates on what a company was importing or exporting for products, that trickles down all the time to a consumer.
Absolutely.
So we're paying taxes on taxes. We're compounding taxes onto taxes. So
you're going to pay tax, that's for sure. So compounding, which is the appreciated value of your investment, is a very dicey topic when it comes to taxes, right? Because when you invest money, if you invest $1,000, the $1,000 that you invest in, you earn. I'm assuming you earn from a legal means, right? Whether it's W-2 from your employer or you have your own business. In those two scenarios, that $1,000 has been taxed, and it should be taxed, right? Because your employer is going to take taxes out, or when you file your business taxes, you're going to pay taxes, right? So the $1,000 has been taxed. So you take that $1,000 that's been taxed, and you invest it in the stock market. You invest it in a company, and the company your $1,000 investment is now $10,000. The $9,000 difference
is getting taxed.
Yes, because the only thing you paid taxes on was the $1,000. That is where you get into capital gains, right? Because the value that you gained has to be taxed. And so that should be reported. So when you sell the asset, obviously if you sell it on an exchange or you sell it on one of these platforms, that's automatically being reported to the IRS. So you don't have to, you don't have to worry about it. It's going to be reported. But when it comes to other types of things like physical assets, like houses or machines or things that, is not a financial institution involved in a transaction, you have to report those, but you still have to pay taxes on capital gains. The typical way of reducing the taxes on your capital gain is if you have a capital loss, because that $1,000 could also go to $10. So you pay taxes on $1,000, you invest it, and then it goes down to $10. You have a loss. But ultimately, I think our goal is to find different ways not to overpay capital gains. And when you talk about retirement, there's retirement accounts, and I won't get into the nuanced detail, but retirement accounts that the money you're putting in there is pre-tax. So there's a lot of flexibility in the growth and the taxation related to the growth, right? And there's investment retirement accounts that is, money that you put in there after taxes, pre-tax, after taxes. The treatment differs, right? Most of your employer-related benefits, most of it is pre-tax, right? So they take the money out before they tax you. So obviously, when it's time to withdraw the money, you should expect some tax, right? As opposed to the other mechanisms where it's post-tax money, then you could see a little bit of a different treatment. But ultimately, what does the government focus on in that regard? They're focusing on the growth, right? So you have X amount of dollars, your $1,000 has become 10. What's the treatment? How the original money, was it pre-tax or post-tax? Okay, if it's pre-tax, this is how you have to treat it, or this is what they expect, and if it's post-tax, this is what they expect. So taxes follow the treatment of the actual initial funds. And there's so many situations where this is typical. I know we're talking about retirement, but generally speaking, if you just want to have a basic understanding, just follow the origin of the funds. It will give you a basic understanding of the potential treatment. Obviously, there's so many tax regulations that you could work your way around different, we'll probably have a tax session and we talk about the raw versus traditional and the maximum and, the tax implications when you withdraw. But ultimately, the path of the income, pre or post, gives you a good indication of how it would be treated for tax purposes. Gives you a general, not spot on every time, but general. So if you have this account that you're funding with pre-tax money and you didn't pay tax on the money and the money grows, you should expect to pay some taxes. So just have that in mind. It's an easy way to remember. So when you start getting into these investment vehicles and the IRAs, just the first thing you should think about is the money that I'm using to fund this, is it pre-tax money? If it is, you should probably expect to pay some taxes on the withdrawal in the future, 10 years, 30 years, whatever amount of years. And the same thing goes for if it's post-tax money, then you can say, okay, there may be some flexibility here because I already paid taxes on the initial funds that I'm using to invest. So I know we're going to talk about, we have a whole section about retirement. We could get into the nuances of the limits for the Roth versus the traditional and the 401k and what that means for taxation, right? That's investment strategy. That's taxation strategy. A little bit more detail. We could get into it at that point. But think of it as pre-tax money versus post-tax money determines, generally speaking, the tax implications.
Okay. And, because I know we got to start wrapping up pretty soon. One of the things I mentioned a little bit earlier was, not negative compound interest, but a negative compound loss. So one, do you get taxed on that too? And two, what's the best way to just avoid it?
Well, the thing is, you generally don't get taxed on losses, right? Because that would be unfair. If I put $1,000 in the stock market and I lose 90% of it, and I have only $100 left, and the IRS says, "Hey, you got to pay tax on the 900 that you lost." I'm like, I don't have the money. I think the IRS is fairly reasonable when it comes to that regard. They don't expect you to pay money on losses. However, they expect you to pay money on gains. And so that's why it's called capital gains tax. There's no capital loss tax. But I'll say this without getting into taxation much, but you could offset your capital gains with your capital losses to reduce your tax exposure, right? So that's part of the tax strategy that you hear from a lot of tax experts is that, okay, so you lost money in January, but then you made money on this. So you lost money on this sale, but you made money on this sale. You lost $1,000, but you made $1,200 here. So it will reduce the capital gains, so you're paying on 200. So there's a way to offset your gains with your losses, and that goes for most assets, whether it's real estate, whether it's crypto, anything that you're buying. When it comes to asset, you could offset the losses with the gains. Even with gambling, we talked about gambling.
Yes.
Not that we support gambling, but if you've spent $100,000 in the casino and you won 200, you should be able to write off the $100,000 you lost before you made it 200,000. So it's always as fair as it can be to offset your gains with your losses.
Well, it's definitely an interesting topic. Definitely one that, taxes are as expansive as the entire word finances and economics. So I don't think people really, take into consideration, okay, finances, but what goes behind finances, economics, what goes behind economics, the macro versus the micro, right?
Yes.
Finances, what your income, your loss,
exactly.
What are you paying for? What are you trying to discipline yourself to not pay for, to not spend money on?
Exactly, behavior.
And et cetera. So, all this to say, any final thoughts that you have when it comes to matters of compound interest and its usage?
I think to close out is from a individual perspective, compounding is really giving you a benefit because of passage of time. And if you look at it that way, from a positive perspective, because you can also lose money, is that you're investing most of the time to take advantage of compounding as time goes by. What does that mean from an individual perspective? The earlier you start, the better. That's all that means. Anybody who starts earlier to put $100 every month into a retirement account will have more money in 30 years than someone who starts in year 5 because they've only done 25 years and the other person has done 30 years. And the actual difference is not based on a simple unit of the difference. It's based on the loss compounding effect that the other person did not benefit from, right? This is how you have to look at it. Compounding and interest rates is one of the key criteria that we use in investing, right? Because you want to benefit and you want to make sure the interest, your return, is higher than a certain number. We don't have to get into NPV and all the other analysis that you need to do to get the right rate of return, but I'm sure we could certainly talk about rate of returns at some point when we get into the details of investing decisions, right? Because corporate companies have to do the same thing, and individuals have to do the same thing, right? You hear people say, "Hey, I'll give you one. I'll close this out. Hey, if you have $100,000, instead of investing it, just pay off your student loan debt." And then you know the question you should ask, right? What's the interest rate on your student loan debt? 1% interest? I'm making this up, right? Because interest rate on student loan. It's 2% interest rate, 3%. How much returns can you get on the $100,000? That's the investment decision. If your student loan debt is 3% or 4% or 5%, what decision do you have to make with that money you have? Should you use that money to pay off that 3% interest-bearing debt or invest it? And if you invest it, you certainly want to make a higher return than the interest rate on your debt. It comes down to that decision.
Well, Yinka, I think with all the knowledge that you have shared with us here today, I think we're good. I think we have a massive wealth of information on compound interest, and not just the broad idea, the general idea, but also the more specific manners of, what methodology could you take into it? How do they kind of work? How do you get into them? And then also the things to consider to getting into them. And to the fish tank, I don't know if anybody back there has any questions. No? Well, then I think with that we'll close out. To our audience, thank you very much for tuning in to this episode of Between Bears and Bulls. We thank you for spending this hour with us, for listening to all the knowledge that you've inquired, that's been imparted to us. And we invite you for every future episode that we'll have, talking about more things, going more in depth with interest rates, with Roth IRAs, with different methodologies of investing. And with that, thank you. Have a good
Thank you.
evening.
This was good. Thank you so much.